Welcome to Simple Chew. Today I will go over wages, more specifically, what the IRS considered wages. I will explain all the different types of wages, salaries, and other forms of employee compensation that are included in gross income. Generally, the employers report annual employee compensation to employees on Form W-2, which the employer must provide to the employee by the end of January each year. On a side note, I know some people might work for companies that don't recognize them as employees. In that case, you might receive Form 1099 NSA, non-employee compensation, instead of Form W-2, wage and tax statement, because their employer did not consider them an employee, uses Form 8919 to report uncollected Social Security and Medicare tax on wages, tip income. All tips received are income and subject to federal income tax. Include in gross income all tips received directly, charge tips paid by an employer, and any tips received under a tip splitting or tip pooling arrangement. The IRS also considers non-cash tips such as tickets, passes, or other items of value as taxable income based on their value. To report tip income correctly, employees must keep a daily tip record, report cash and charge tips to the employer by the 10th of the following month if $20 or more. Report all tips on the income tax return, with the exception of tips reported to the employer after the end of the year. That will be reflected on the employee's W-2 in the following year. Tips reported to the employer on time are considered income in the month. Reported tips that are not reported on time are considered income in the month actually received. Tip. Employees who receive tips of less than $20 in a calendar month aren't required to report tips to their employer, but must report these amounts as income on their tax returns and pay taxes, if any. Example. Jack Smith began working at the Deep Sea restaurant, his only employer for the year, on June 30th, and received $10,000 in wages during the year. Jack kept a daily tip record showing that his tips for June were $18 and his tips for the rest of the year totaled $7,000. He wasn't required to report his June tips to his employer, but he reported all of the rest of his tips to his employer as required. Jack's Form W-2 from Deep Sea Restaurant shows $17,000, $10,000 wages, plus $7,000 reported tips. In Box 1, he adds the $18 unreported tips to that amount and reports $17,018 as wages on his tax return. Tip income is subject to Social Security and Medicare tax. The taxpayer must give the employer a written report of all cash and charge tips if receiving $20 or more in tips during a month. A taxpayer uses Form 4137 to figure the Social Security and Medicare tax owed on tips they did not report to their employer, including any allocated tips shown on Form S W-2 that they must report as income. The taxpayer must report the value of non-cash tips to the IRS on the tax return, but not to the employer. The taxpayer does not pay Social Security, Medicare, additional Medicare, or railroad retirement taxes on non-cash tips. A taxpayer may be subject to a 6652B penalty equal to 50% of unpaid Social Security and Medicare taxes due on unreported tips. The penalty amount is in addition to those taxes. The taxpayer can avoid this penalty if there is a reasonable cause for not reporting the tips to the employer. To do so, the taxpayer attaches a statement to the tax return explaining the reason for not reporting the tips. Stock options. If an employee receives a non-statutory stock option, also called non-qualified stock option or NSO, that has a readily determinable fair market value at the time it is granted, the option is treated similarly to other property received as compensation. Otherwise, the amount of income to include and the time to include it depends on the fair market value of the option. When the employee does one of the following: exercises the option, uses it to buy or sell the stock or other property, sells or otherwise disposes of the option. However, If the option is a statutory stock option, also called incentive stock option or ISO, the employee will not have any income until they sell or exchange the stock. The tax treatment for ISOs is more favorable than that of NSOs. Capital gain tax rates apply to gain from ISOs if an employee holds the stock more than 1 year from the date of exercise and more than 2 years from the option grant date prior to disposing of the stock. Otherwise, ordinary income rates apply to the gain at the time of sale. Example: in 20X1, Macromedias grants Ben non-statutory options, giving him the right to purchase 1,000 shares of Macromedias stock for a price of $25 per share. On the grant date, Macromedias shares traded at $5. Ben does not recognize income when he receives the options because his exercise price is above the current share price. Therefore, there is no readily determinable market value. In 20X9, Ben exercises his options when the price of the stock is $95. He receives $70,000 in compensation, which is the difference between what he pays, $25,000, and the value of the stock at exercise, $95,000. Macromedias should include the compensation on Ben's W-2 and withhold any applicable Social Security and Medicare tax. Severance pays, and any payment received due to the cancellation of an employment contract must be included in income. This included any payment received for accrued leave and monies withheld from severance for outplacement services. If a taxpayer accepts a reduced amount of severance pay in order to receive outplacement services, such as training in resume writing and interview techniques, he must include the unreduced amount of the severance pay in income. Sick pay received from an employer, while sick or injured is part of salary or wages. In addition, employees must include in income sick pay benefits received from any of the following payers: a welfare fund, a state sickness or disability fund, an association of employers or employees, an insurance company. If the employer paid for the plan, however, if the employee paid the premiums on an accident or health insurance policy, the benefits received under the policy are not taxable. Restricted property. Generally, the fair market value of property received for services is income in the year the taxpayer receives the property. A taxpayer does not include the value of stock or other property in income if certain restrictions affect its value, e.g., a substantial risk of forfeiture. The taxpayer must report the property as income once it substantially vests, is no longer restricted. A taxpayer can choose to include the value of the property in income in the year the transfer occurs if making a proper A3B election within 30 days of the grant date. The election is made by sending a letter to the IRS, see Rev. Proc. 2012-29 for example. The IRS treats restricted stock dividends as compensation and not as dividend income, unless the taxpayer has recognized the stock as income. The holding period begins when the taxpayer includes the amount in income. The benefit of the A3B election is that future income or gains may receive the more preferential dividend and capital gain tax treatment. Example: your employer gives you $50,000 in stock for services performed under the condition that you'll have to return the stock unless you complete 5 years of service. The stock is under a substantial risk of forfeiture and isn't substantially vested when you receive it. You don't report income from the stock until you have completed the 5 years of service that satisfy the condition. You could elect under 83B to include $50,000, the value of the stock, in income within 30 days of the grant date. Essentially, an 83B election is utilized when the underlying asset is expected to appreciate or substantial dividends are expected. In the absence of such an election, the value of the property, including any appreciation since the grant date, is taxed at ordinary rates when the restriction period ends. If the stock is worth $150,000 after 5 years, the taxpayer would report the entire amount in income, taxed at ordinary rates. As an alternative, the 83B election would cause recognition of $50,000 in the first year, and any appreciation is taxed at more favorable capital gains rates when the stock is sold. Bonuses and awards. If you are the lucky ones that received a bonus or awards, you guess it. If you received any bonuses or awards from your employer, they are included in income and should appear on the Form W-2. If the award is goods or services, include the fair market value in income. Disability income. Generally, employees must report as income any amount received for personal injury or sickness through an accident or health plan when the employer pays plan premiums. If both the employee and employer pay for the plan, the employee must report only the amount received that is due to the employer's payments. However, certain payments may not be taxable to the employee. For example, a taxpayer need not report as income any reimbursement for medical expenses incurred after the plan was established. A taxpayer may need to include reimbursements for medical expenses deducted on a prior return as income in the current year. Accident or health plan. Generally, the value of accident or health plan coverage provided to a taxpayer by an employer is not included in income. Benefits received from the plan may be taxable. Fringe benefits. Fringe benefits received in connection with the performance of services are included in income as compensation unless specifically excluded by law or the employee paid fair market value for the benefits. The IRS treats abstaining from the performance of services, for example, under a covenant not to compete, as the performance of services for purposes of these rules. Group term life insurance. Generally, the cost of up to $50,000 of group term life insurance coverage provided by an employer or former employer is not included in income. However, the cost of employer-provided insurance that exceeds the cost of $50,000 of coverage reduced by any amount paid toward the purchase of the insurance must be included in income. If an employer provides more than $50,000 of coverage, the employer must report the amount included in income as part of wages in Box 1 of Form W-2. Employer-paid premiums for whole life or permanent insurance are included in the employee's income. Foreign income. U.S. citizen and resident aliens must report income from source outside the United States, foreign income, on their tax return unless it is exempt by the U.S. law. This applies to earned income, such as wage and tips, as well as unearned income, such as interest, dividends, capital gains, pensions, rents, and royalties. U.S. citizens and resident alien residing outside the United States may be able to exclude all or part of their foreign source earned income. If you guys need more info on that, I can go over foreign earned income exclusion on a different video. Advance commissions. As from my last video, you are using the cash method. A taxpayer receiving advance commissions or other amounts for future services must include these amounts as income in the year received. Cost of living, allowances, and reimbursement. Cost of living allowance are generally included income. However, allowances for a federal civilian or federal court employee stationed in Alaska, Hawaii, or outside the United States are exempt from the rule and are not included as income. Allowances that increase an employee's basic pay as an incentive for taking less desirable assignment are part of compensation and must be included in income. Back pay. Amounts awarded in a settlement or judgment for back pay should be included in income. These include payments made to a person for damages, unpaid life insurance premiums and unpaid health insurance premiums. Employers should report on Form W-2. Child care provider. When taxpayers provide child care, regardless of location, the payments received must be included in gross income. Taxpayers who are not employees must include payments for services on Schedule C and complete Schedule 1. The same rules apply for persons babysitting, even if only periodically and/or just for relatives. Thank you for watching.